Welcome back to the channel, people, and today we are breaking down one of the biggest and most important companies in the UK stock market. That is right, it is Tesco's. We're going to be looking at the business and we're going to look at the preliminary results, the financials, the risks. The ultimate question is Tesco's a long-term hold in the portfolio? Everything in this video comes directly from Tesco's latest results. The slides should be seen on the screen, so let's get into it. So the big question is Tesco's a long-term hold? Well, Tesco's is one of those companies that doesn't always make the headlines, but it's quietly plays a massive role in the UK economy and in many people's portfolios. To understand where it deserves a place though in our long-term strategy, we do need to break down the fundamentals. So let's start with the basics. So Tesco trades under the ticker TSCO with a share price of roughly 488p and a market cap of roughly £31 billion. It's a UK-based retail giant operating across the UK, Ireland, and Central Europe. What makes Tesco's interesting, though, is from the dividend investor perspective. It has a 5-year dividend growth of roughly 5.84% and a dividend yield at 2.95% of the dividend. This is business with history, and it's founded in 1947 and today is led by CEO Ken Murphy. So straight away, we're looking at a mature, stable, cash-generating company, and it's also doing very well year to date at 10.27%, 1 year over 36%, 5 years up 119%, and 10 years 169%. So that is quite a good result for Tesco's already. So the full year 2026 snapshot, or roughly in the preliminary results, Tesco's delivered up 66.6 billion in sales, up 4.6% year on year. The adjusted operating profit came in at 3.18 billion, up slightly at 0.8%. The free cash flow, one of the most important metrics for long-term investors, hit 1.67 billion, up 11.7%. Net debt sits about 10.58 billion, which is manageable for a company of Tesco's scale. EPS grew 6% and the dividend increased by 5.8%. This is classic Tesco, steady, reliable, incremental growth. Nothing flashy, but consistently moving in the right direction. But how would you read the retail earnings? So before we go deeper, it's important to understand how to actually read retail earnings. This is a basic rough estimate. I'm not always good at it, but this is what I kind of try and follow. So retail is low margin, high volume business. That means the key metrics are a little bit different from tech and industrials. So here's what I think is what matters. Well, sale growth. Are Tesco's choosing? Are customers choosing Tesco's over rivals? Margins. Can Tesco's protect profitability while invested in price? Cash flow. Can the business fund dividends, buybacks, and reinvestment? Debt. Is the balance sheet safe? And is shareholder value compounding for the EPS? So this framework should work for any supermarket stock. And if anybody has any more tips or any feedback on that, I would be appreciative for that one. So let's jump into the sales performance. So Tesco's sales performance this year was strong across the board. UK sales grew 4.2%, Ireland grew up 6.2%, and Central Europe grew up 2.5%, which is quite good. Group-wide, like-for-like sales is up 3.5%. This tells Tesco's is still winning, and customers, even in a competition environment, with discounters like Aldi, Lidl, are pushing hard. Now, of course, this is for the adjusted rate, so as you can see, it's quite good indeed. So, why does this matter? So, why does growth matter a lot? Well, sales growth is an engine of grocery profitability. When margins are thin, so volume is everything. So when Tesco's grows sales, it strengthens its market share, which gives it more pricing power and more leverage with suppliers. The fresh food sales were up 6.9%, which signals strong customer trust and quality. And even online sales grew 11%, showing Tesco's is winning in convenience, but also in delivery, which is two areas that are becoming increasingly important in nowadays life. And here is the profit and margins. Now, as you can see, margins dipped slightly because Tesco's actually invested heavily in price cuts, club card deals, and quality improvements. However, there's one key element in this. Profit still grew. That is operational strength. Tesco is managing to stay competitive on price while still protecting profitability, something not everybody can do. And they are also doing the save to invest, which is one of Tesco's biggest competitive advantages. It's a save to invest program. This is a multi-year efficiency strategy that frees up cash to reinvest into lower prices, better service, and colleague pay. In full year 2026 alone, Tesco's delivered up to 535 million in savings. Over 4 years, that total hit 2.2 billion. And they've already set a new 500 million target for full year 2027. This is Tesco's secret weapon. It allows them to cut prices without destroying margins, something that competitors simply can't match at the same scale. And once again, we're going to go on to the most important metric for any company. That is cash flow. Cash flow is the lifeblood of any long-term investment. Tesco's generated 1.67 billion in free cash flow this year. This is what pays dividends, this is what funds buybacks, this is what strengthens the balance sheet. A company with strong, consistent cash flow is a company that rewards shareholders year after year. And the balance sheet strength is also looking solid. Net debt sits around 10.5 billion, as we mentioned, but the net debt to EBITDA is 2.1x, which is comfortably within the investment grade territory. This gives Tesco's flexibility. They can invest, they can return capital, they can weather downturns. And getting on to shareholder returns, Tesco's continues to do that with significant value. EPS is growing, dividends are growing, Tesco's continues to buy back shares, reducing the share count and boosting the long-term EPS growth. This is exactly what you want to see from a mature, cash-generative business. But it's not all rosy-dory. There are some risks and there are some headwinds. Of course, no investment is risk-free. Tesco's faces macro uncertainty, rising costs, intense competition from discounters. Margins could come under pressure if the economic environment worsens, but Tesco's scales and efficiency gives it more resilient than most, and they're expecting 1.5 billion to 2 billion in free cash flow, in line with upgraded medium-term guidance range set out of the above. But does this mean is Tesco a buy, sell, or hold? In the bull case, Tesco benefits from defensive demand. We all need to eat. It has a scale, market share, and a structural advantage through save to invest. It generates its strong cash flow and returns capital consistently. Its model, stores, online, express, broker, gives it multiple growth levers. However, margins could face long-term pressure from Aldi and Lidl. Regulatory and operating costs are rising. The strategy is complex and requires flawless execution. And if cash flow ever softens, debt and lease could become more of a concern. However, Tesco isn't a high growth rocket ship, it's a steady compounder. And if you want stability, cash flow, dividends, and a long term consistency, Tesco does fit that profile. If you want explosive growth in your portfolio, this isn't the stock. But as a long term hold in a diversified portfolio, I think Tesco makes a good case for that. If you found this breakdown useful, then of course hit the like, hit the subscribe button, and let me know which company you want to be analysed next. And go and check out the links down in the description because there's an opportunity for you to grab some free shares today and start your investing journey. But just once again, remember, I'm not a financial expert, so please do your own research. But I hope you guys enjoy, and I'll see you on the next one. Goodbye.